In today's feature guest, Norm Levine, Managing Director and Portfolio Manager at Portfolio Management Corp. Norm, good to be with you and get your perspective today.
Good to be here, Catherine.
You've been in the business a long time.
42 years.
That is a while. Give us your perspective in terms of what we're seeing today.
Okay.
And have been, because today is a light trading day.
Today's a light trading day because it's a pseudo holiday, so there's less volume, less liquidity, so moves may be exaggerated, maybe not today. But what you've had for the last few years has been a technology momentum stock-led market in the U.S. The U.S. has been pretty much the best market in the world, and it's been a select few, and it has been really a few stocks that have powered that market, and most of them are favorites of people, but when you go down to see what do they actually earn, some of them earn nothing, some of them lose money, some of them make a little bit of money, so their valuations have had nothing to do with where their stock prices have been. And if you look back to the tech wreck back in 2000, in 1999 and early 2000, you had similar things going on where technology stocks back then were running and momentum just kept them going, but there was air underneath. There was no valuations to keep them where they were should something come along.
Well, no profit to support the valuation.
Right. And always something comes along, and it's never something that people predict. People always say, well, what's going to end the bull market? And people guess, and it's never anything that you can guess. Mm-hmm. And this time, and I'm not saying for sure the bull market is over, but it's showing signs of that, at least for now. It's two things that came out of the blue. One was President Trump and his protectionism. Mm-hmm. People who go back in history know that protectionism is the absolute worst thing that can happen to any economy and any market. And that's because it basically slows down and almost shuts down economies as they become totally inward. And secondly, interest rates have been going up in the U.S. and look like they want to continue to keep going up. And as they go higher, they start to fight against those high-flying stocks. Money starts flowing out of those into fixed income. The two together here seem to be causing this.
Let me ask you, though, Norm, two items here. One, from a protectionist perspective, obviously President Trump would say he's not being protectionist. He just wants fair trade, not free trade. And when you do actually take a look at the numbers in terms of the trade deficits that the United States has with other countries around the world, he's not all wrong. You've got China, but next in line is actually India, if you really look at the numbers here. And if anything, he's trying to bring back, obviously, economics and money to the United States. So some people would say that in his pursuit of that goal, and it seems as though he's continuing to move down that path, that's actually going to create even more wealth in the United States. It might have a lot of disruption going on for the rest of us, that is for sure.
Who's it going to create the wealth for, Catherine? Joe Average in the U.S. doesn't have much in the way of savings, lives hand, a lot of them live hand to mouth. So when you start putting on protectionism in favor of your domestic things, all these Chinese and Indian goods start going up in price or start getting replaced, and Joe Average can no longer afford to buy these things.
Well, there is, to your point, though, there is, of course, the possibility that what he is doing is going to cause inflation to move much higher than anybody's expecting. So to your point, yes.
So there's inflation, not just inflation, Catherine, but also if people can't afford to buy the goods, then the economy starts to slow down or go negative if they can't keep the economy going.
Right, but the other side of it is if he's bringing jobs back to the United States, that these people will have jobs and probably higher paying jobs because there's going to be a lack of supply to fulfill those jobs. So you will potentially start to see wage pressure.
Right,
and then they'll be able to afford those goods.
And then
they're going to be chasing
governments like China, which are the biggest holders of U.S. Treasury bonds, start to sell those bonds because they're not getting, they buy those bonds because they're selling the U.S. goods, and the U.S. is paying them in U.S. dollars, and they're taking those dollars and investing them in bonds. They start selling those bonds. What does that do? It starts sending interest rates up. Mm-hmm. What does that do? Choke off an economy. So you've got two things. The Joe Average can't afford to buy anymore, and interest rates are going up. That's it.
So that's going to take a while to play out, Norm. Between now and when that potentially plays out, do you not agree that the near-term impact could actually be a stronger U.S. economy. That's what a number of strategists will suggest, that in the near term, got a U.S. economy that's already strong, let alone if he starts to really bring back these jobs and you start to see wage inflation, you'll see the consumer pick up. We could own the retail stocks. Do you buy into that?
I'm not buying into that. No, I don't. And I always say the market looks forward, so it may take that into account and then disregard it, saying, but look further down the road.
Okay.
And the road does not look good if they continue on this path. And it's not just China and India they're going after. They're going after Canada and Mexico as well. Canada has no trade deficit surplus with the U.S., but they're going after us anyway.
Right.
Facts don't seem to matter.
With respect to the tech sector, because that's really, what it was so responsible for the great performance of the U.S. markets, as you mentioned, falling out of bed a little bit, has been. Do you really liken this to 1999?
In 2000? In 2000, yeah.
Yeah, but
Yeah, I do.
Yeah?
I do start to look at that because it's the same, maybe the names have changed, but it's the same type of stock that has been doing this. And what ended up happening was they throw the baby out with the bathwater and all stocks are down. You'll see today it's not just technology stocks that are down. It's fairly broad-based who's going down. In the U.S., Canada's different. Canada's actually only down about half as much as the U.S. because it never went up.
Right.
So it's not going to go down as much. So they throw the baby out with the bathwater, all the stocks go down. Once this starts to settle down, money starts to flow into those companies that are more reasonably valued, that hadn't participated before, and there's a rotation that goes in and those stocks start to do well. The indexes don't necessarily reflect this though, because the indexes, because they're market weight dominated, the S&P 500 and NASDAQ are anyway, they reflect those big weighted stocks, which will help bring it down more than the average stock and hold it down more than the average stock. The average stock can start going up and it won't show on the market for a while because of how indexes are done.
Just to wrap up, though, the tech conversation, because, I think we've just been following these stocks for so long. It doesn't sound like you're tempted at all to step in at some lower
No, because
level.
the valuations still, to me, don't make any sense. They've got a long way to go.